Welcome to the Whole Enchilada, a community of high achievers that fight the status quo, rebel against mediocrity, and make life happen. Let's go.
Hey, Enchilada Nation. I am excited to share this conversation with you today. I think it will be a real treat for you. We talk a lot about inflation. We're all feeling the pressure of inflation in our expenditures. Everything we buy every single day is costing a lot more money. However, to me, that's not the most important conversation we should be having around inflation. We're so focused on building our future and investing in our future. We need to be thinking through, how is inflation affecting our ability to build wealth long term, and what strategies may we have been implementing yesterday in our investment strategy that should be shifted based on inflation showing up in our market and staying in our economy moving forward. So what I did is I invited two of my very close friends, Johnny Christensen and Shoni Ivins, to come in. They're very brilliant investors. And I challenged them a few days before the conversation to come prepared to talk about, what can we learn about inflation historically, and how are you changing your investment strategy moving forward to win in an inflationary economy? This is a conversation you're going to love. It is a two-part series. The first part, we're going to talk about kind of the history of inflation and what's caused inflation and what we can expect from that. The second part of the conversation, we're going to move into specific asset classes that you may want to consider in looking at your investment strategy moving forward, and historically how those asset classes have reacted to high spikes in inflation historically. So again, I think this conversation is going to be really valuable. Be sure to listen to both parts, and don't forget, go live life on your terms. Well, I've been excited about having this conversation with you guys. It's interesting, I think, over the last decade, the three of us and a lot of our people in our worlds have been focused on growing their income, getting better at what they're doing. And we've been in this the wind has been at our back from an investment standpoint. I don't want to say it's been easy to make money, because we all work very hard for our money, but we've been in an economy where if you want to put forth a little bit of effort, you could have been making money. And then also, if you didn't have to be a genius investor to take some of that money and decide not to spend it on things, but put it in some element of an asset, whether it be stock or real estate, and there was a good likelihood because of the market that went up. So I think, and I'm putting myself in this category too, and I don't want to make it sound like I don't think this about me as well, but I'm questioning now, is how much of my success from increasing my active income and how much of my success from an investment standpoint has been because I've been really purposeful in how I've been investing, versus how much of that success has come just from a result of the market. And what I don't want to do is to go through the next decade and be like, why did my investing not work the same way that it did in the last decade? Because I didn't react to the economy and the market we're in. And I think we talk a lot about interest rates and all these things, but if you whittle it all back down, it really has to do with us being in a high inflationary market, and how do all of the different asset classes, including businesses, react in an economy that has been on the tail end or in the middle of a high inflationary market. So that's why I wanted to have a conversation with you guys today around inflation, what we predict is going to continue to happen with inflation, and how are we thinking through our money and where we're allocating that money in an inflationary market to make sure that we're getting the maximum back on our dollars. So before we jump into any of those topics, like, does that resonate, that thought process resonate with you guys?
Yes, because I think about that too. Me and you have had that conversation of like, whose success is luck versus skill set, or a combination of those two. And so I look back at my journey. I started 2007, 2008-ish, in real estate investing, that type of thing. So I didn't have that immediate launch that people maybe that got into whatever profession, 2013, 14, 15, like, yep. It seems like it only was a straight decade of up. I was nothing but a bottom and then an up. So I think maybe it was a little different skill set or all that, but I've been all in on real estate the last little bit, mostly out of factual information, because I've been a real estate guy. So like, I think there's a lot of reasons that benefited me on the things that I chose to do, but I'm no dummy either, or not naive in the fact that like real estate's been a fantastic sector to put some money at the last decade. That I've been very beneficial from, and me, I'm turning 40 this November. So like, I'm thinking in decades a little bit. So the last decade's been a big real estate decade, but as I think about my 40 to 50, there is some substantial things that I've learned that I'm going to change or adapt or do differently, as I journey through this next decade. That's not all in on real estate. So I'm happy to have that conversation. Yeah.
And I do think that's interesting. One is I know real estate historically has been a very strong asset in an inflationary market, right? And so that's one of the reasons I've been focused on it, but it's also the space we play in. So it's like, I'm familiar with it. It's like, I tend to like investments that are tangible. I control, I can drive by it and look at it. I can do specific things within my expertise to affect the value. And so it's interesting. I want to continue to play in that space, but I also, Johnny, you and I have talked about this, like the evolution of our careers. You're getting to a point where it gets challenging to make sure all of your capital is to work if it's you making all of the decisions. So now it's like saying a portion of your portfolio is how do you put that to work with less of your brain power, making sure that you're still maximizing the return on those dollars in excess of or equal to the dollars I'm investing, where I am taking a more active approach with that investing. So it's about like this interesting thought process of like how to get your dollars to work and not only maximizing the return, but also asking the question, how much of my time and energy does it take to get that return?
Yeah, no, I forgot the analogy, but it's, the tide rises all boats. So you look at the last decade, it's been hard to just totally lose, because not only has inflation increased prices that we're paying for things, but assets, crypto, stocks, bonds, like everything has been great to have your money in. But I think the next, year, 2 years, and then what's going to happen after that, the next decade, it's, everybody thought they were really smart coming out, up until probably 2 years ago, year and a half ago. So I'm glad there's humility creeping in, but I also think true wealthy people prove they're wealthy over multiple cycles, so when you're looking at a 30-year wealth building career, like they've had to pivot, change, adapt, and bring some other things into their wealth building strategies. So
Put together a list of questions or thoughts that I wanted to chat through, and then not necessarily that we have to follow that to a T, but let's just start there, and just wherever comment comes or suggestion comes along the way, let's just follow that thought process. But here, to me, one of the biggest questions before we get into like how do I hedge my investing dollars against inflation? I think the first question we have to ask is like, can we count on us continuing to be in a high inflationary economy? Like it's for those of you watching on YouTube, like there's a graph I'll pull up here to show, but it shows the cumulative inflation from 1913 to 2022. And if you add inflation, so if one year it goes up 4%, the next year 8%, and that's accumulation of 12, and you keep adding that up, from 1913 to 2022, the cumulative inflation is 2,923%, which is insane. But the thing that really surprised me on this is we haven't really talked a lot about inflation over the last couple of years, we have talked about it over the last couple of years, but before that, we didn't talk a lot about inflation. But this graph shows a pretty significant spike in continuation almost since I was born. So maybe I was the problem. Maybe things got more expensive when I was born in 1980. But this is interesting to me. So I think the first question we ask is can we count on us staying in a high inflationary market moving forward? And if you think so, why? Why are we going to stay in a high inflationary market?
I think it's interesting too. One of the things I could hear you guys, but I wasn't able to chime in. But I think the reality is like part of the problem with inflation is that it's part of the mechanism for how the government runs, right? So it is actually something that is not by accident, it's actually by design. And so from my perception, the rate of acceleration when it comes to inflation is just consistently increasing. And so for me, I definitely think that we're going to continue seeing this inflation, throughout the next decade, if not even more than we have in the past.
Yeah, I'm in agreement with that. Johnny, thoughts on that?
Yeah, and I know you'll probably have a few more slides you share, but like when you move a currency off of a physical commodity based, or backed currency, this is beyond the United States. This is just what happens when you remove that physical commodity. So that's the definition of fiat money right there. Government issued currency that is not backed by physical commodities such as gold, silver, but rather by the government that issued it, right? So if you look at the next one, Richard Nixon, like what did he do at the beginning of your graph before it went bonkers? Was on August 15th, 1971, Nixon announces before the nation that he is removing our, US dollar being backed by super Fort Knox gold that's just stacked in, safes underground or whatever, right? And that even back then was supposed to be just temporary, a couple of years or whatever, but governments have somewhat of an addiction to spending or a little bit of a lack of accountability on budgeting. So like as soon as you remove that, their ability to print and just continue to issue debt almost feels like they don't have as strict consequences,
Yep.
So like just knowing how governments operate, it's hard to think that we're not going to be in an inflationary economy in the future. Do I think that we'll kind of get it in control, get out of control a little bit more here and there? Yes, but even the last 10 years, when you talk about what happens with abundance, with all these assets, people making good money, real estate going up, crypto, stock market, all that, like by nature, people have more cash, currency, or assets. And then when they go to buy things, there's more buyers in the market that can bid up the natural, supply out there, which price has gone up. Like, I don't really know a lot of categories the last 10 years that prices didn't just go out of control. Even the real estate market, we know, like we went bonkers there for a little bit in the fact that people were just throwing so much money at purchase prices just because of the lack of inventory, and things were getting 30, 40 offers on it, bid up, 50,000, 100,000 over price. It did get crazy, but I think we'll get it in control, but I still think to some degree, we're going to stay in an inflationary economy for quite a long time.
Yeah, I agree with that. I mean, we all three of us get the opportunity to coach people on their personal wealth building strategies. And you think, just to give some context on what you're saying, if you were coaching somebody, an entrepreneur comes to you and says, hey, I'm going to be vulnerable and tell you my personal wealth situation. I've got $103,000 of debt and my expenses are outpacing my income by 20%. Like, it's pretty easy what you're going to coach them on, right? It's like, we got to stop spending more money than you're making, and we got to eliminate that debt. Otherwise, it's a noose around your neck and any ability to move towards prosperity. And for some reason, that coaching or that thought process in an individual standpoint makes so much sense. But what I just articulated to you is, if you take the federal debt, which is $34 trillion, and divide it by the whole total population, even the person that was born yesterday of the US, that we're in debt $103,000 per person in the US. Yet the government, on all of the things that are approved right now from a budgetary standpoint, is in excess of what we're earning right now as a government. So there is no other solution besides printing money. And as you guys know, we're in a political year with the presidential election. And if you look, I went to ChatGPT and asked to outline specifically what is the fiscal policy differences being proposed by the Trump administration versus the Biden administration. And they are night and day on how they propose to address this federal policy. Any thoughts on that?
I was actually just thinking that, watching the debates this past week, when asked about, a lot of the debt crisis that we're in, neither one of them wanted to talk about cutting, any kind of government spending. And if you even just, going back to your other point about just the magnitude of our inflation issue right now, if you actually, in our debt crisis, if you actually just look at the interest that we have to pay on our debt on an annual basis, that's supposed to, by the next 12 months, supersede or exceed the amount that we spend in defense for our country. And so, in the next couple of years, it could exceed $1 trillion in just interest that we pay on the debt. And I know that $1 trillion mark is really, like, the trillions in general is a hard number to quantify or understand. If we were actually to kind of look at it in a perspective of time, 1 million seconds ago was about 12 days ago. Right? If we look at 1 billion seconds ago, that's 32 years back in history. But if we do a trillion seconds ago, that's something like 31 million years, 31,000 years ago. Okay. And so if you just say, okay, what's the difference between $1 million and $1 trillion? We're going to be spending $1 trillion in interest on our debt within the next 12 months. So that's just like, mind boggling. And both of them, when we look back at the debates, they talked about, well, Trump really hit on this, is that one of the only things they're planning on doing is trying to grow our way out of it, right? So that usually comes from more spending. Productivity really is the only way to be able to exceed and try to get around that curve of the debt crisis.
Yeah, I think that to me is the biggest difference. And I don't want to turn this into a political debate at all, but it's interesting that it feels like Biden's proposal is, well, we do need to make more money to offset the expenses, so let's tax more people. Let's charge more in taxes to everybody. When I think Trump on the other side is very much about tax incentives to promote the economy moving forward and circulate more dollars and then get our budget back in check. So it's interesting how different they are in their approach to it. But there's every decision, whichever decision is, whatever is implemented, just like we're talking about our investment dollars, whatever decision is made immediately, there's a long-term triggered effect to it, right? I mean, all three of us are entrepreneurs on this call, and at some point, getting overtaxed and under incentivized to be an entrepreneur, at some point, the three of us will just be like, well, what are they paying at the bank? I'll just go do that and not create jobs, not create additional opportunities for people, which is will stagnate our economy. So it's an interesting time in what the future holds from opportunities. And that being said, is why we're having this conversation now, is like how do we protect the value of our dollar so that regardless of what happens, the dollars we've already earned have the most power moving forward.
Yeah, and even if you look at that graph when we removed from the gold standard, I have a grandpa that was born somewhere in the 40s, maybe early 40s. Clearly, he had grown up with parents that had lived through the Depression. So, like, it was just a whole different time. And it was a very, frugal, like, make your dollar stretch time period. But, back then, even the cumulative inflation, like, the possibility of saving your way to wealth was a lot more potential, back then before it just got out of control. And now, like, I know we'll talk about some of these questions, but like inflation has just been so much more aggressive and extreme that your ability to save and hold and just try to just live a normal life does not work in a society like we've been in the last little bit, right? And so part of that is the worst thing you can do is hold your money in a fiat currency. And the thing that we've had success with, and the thing that I teach in every like wealth building investing class ever, is you gotta live below your means. So there are something at the bottom for you to go out and put invest, but you've got to put it in assets that are going to not only match but beat inflation and have a good investment return for you to build, or sock something away for the future, or your kids or whatever, right?
Yeah, I think that's interesting. Like you remember when we were kids, we would say like, oh man, when I grow up, I'm going to be a millionaire. And that just sounded like gobs of money. But if you're watching on YouTube right now, you can see this graph kind of staggering to me, that if you had $1 million in 1971, which you would have been considered really wealthy to be a millionaire in 1971, but that $1 million, for you to have the same buying power today as that $1 million in 1971, you would need $7.7 million to have that same buying power, which gives you some feel. And then the other graph that I thought was or the opposite of that is if you had $1 million today, that would be as if you only had $129,000 of net worth in 1971. And then this graph, to your point, Johnny, which I thought was really interesting, which shows a graph of a $100 bill saved and stuffed in a mattress in 1950. If you left that $100 bill stuffed in your mattress from 1950 to 2004, the buying power of that $100 bill would only be $7.50 worth of value. And so to me, this is the biggest risk we have, is people saying, well, I need to save more money. That cannot be the solution, because you cannot save at a faster pace than what inflation is going to continue to have the impact on the power of money. Is that in alignment with what you were saying, Johnny?
Yep, totally. And I've got some businesses in Argentina that you guys know about, so it forced me to pay attention to Argentina, and their economy and their inflation. And their inflation has been over 100%, every year for the last couple of years. So whatever we've dealt with, times it by like 10, 20. And that's part of it is just like they came out of an economy as just this cash savings, even US dollar savings, country. And it's just, man, inflation really can be one of the most detrimental things to a government and an economy. So like, I get all the focus that we put on it, but not only there's currency strategies, but there's also going to be personal investor strategies.
If you are enjoying this conversation, please, who do you know that you can share this episode with today that will find value in it and would also like to join us on our journey to become the best version of ourselves? And don't forget, please like and subscribe, because this helps me get in front of more people just like you to continue to grow our network and our Enchilada Nation. Thanks again. Let's get back to the episode. I think that's interesting. I looked at a graph in preparation for this meeting too, where it kind of gave the next 10 years prediction of the world inflation rate, and then it broke down by advanced economies, which seem like it will recover a lot faster, but unadvanced economies like Argentina, it actually it takes longer for them to recover from world inflation problems, which is interesting. Like as you look at that, it causes some concern locally, but it also causes some concern for some of these emerging countries that have been trying to climb out of it. Could be a longer run for them. So one other thing I think is really interesting for us to talk about, because we know that interest rates have gone up with an intention of slowing down consumer spending, which if consumer spending slows down, there's less money circulating, so people will be more cognizant of the decisions they're making, which will decrease demand on supply, which will theoretically increase supply, which should soften the acceleration of the cost of those items. But it's important I've had some conversations recently with people that are confusing disinflation with deflation. Because even if these strategies work to slow down consumer spending, I do not see a scenario in which we experience deflation in our market, which is actually going below the cost of things of where it was this year. Maybe a handful of items will go backwards on price, but across the board, I don't see a scenario in which across the board will drop below that 0%, like a negative inflation number, which disinflation is showing up where it's slowing down the rate of inflation. Do you guys agree with that? Do you see a scenario in which we'll experience deflation, or do you think it's just a matter of disinflation that we're going to experience?
Yeah, I think maybe kind of all could be in there, just depending on what we're talking about. Like the perfect category. Like when you talk about deflation, it's just like actual prices being lower this year than they were last year. I go buy an iPhone, instead of paying $1,000 like I did last year, I'm going to pay $800. That's deflation. And there are some technologies and innovation that can actually lower prices, which could be healthy. Because when I think of my natural instinct when I think of deflation, I'm like, heck yeah, that means stuff's going to be cheaper and I can buy more of it. But the reality is, when you have deflation, just like the tide rises all boats, it can lower all boats. So if we get into a deflation scenario, like that means everything could be less. And it would all just be a perspective at that point. So your real estate assets, your crypto, your currency, your incomes, could all go down. So I do think deflation is also very negative to an economy. Disinflation, that just slowing down the rate, we always set that inflation percentage at 2%, so going from 5% down to 2%, that's slowing the rise of prices kind of across all those bundles of goods and services. So I do think it's very important to distinguish between those, because you don't want everything to all of a sudden be less value across the board.
One of the problems I foresee as well, and I don't know if there's a direct answer to this, but how many companies, once, most of them, they have to adjust their price based on the cost it increase for them to generate their product, their service, whatever they're providing, right? And when we, shift into this next market, the question is, how many of them, if they get back to a healthy profit margin, are going to reduce their prices? That's just not a part of the intrinsic design of companies. There are some services like TVs, for example. TVs are far more cheaper today. Some technologies are far more cheaper today than they were 20 years ago, right? But that just does not apply for a lot of the everyday services that people buy, where if you go to McDonald's, they're not going to be starting, once they set this new standard of what their pricing for a Happy Meal is, they're not going to say, let's actually reduce that cost of the Happy Meal just because our price has gone down. They're going to say, no, now we have new profit margin that we get a benefit from. So that's one of the challenges that I also foresee, is that a lot of services now have this new higher cost that may not come down.
Yeah, I agree with that. And I think it's interesting too, because where we've had a growing middle class, I think that a high inflationary market actually separates economies, right, within an economy, or classes within an economy. For example, like Johnny, to your point too, I think where we will see deflation potentially are in big ticket items that people generally are borrowing money to buy, right? Houses, cars, a lot of times iPhones, people are borrowing money for those on a payment plan. So if you went in with cash to buy you are buying it cheaper. If you're going in and borrowing money, even though the price tag is less than it was a year ago, because interest rates are higher, they're really not buying it in a deflationary state, right? They're ended up paying the same or more for it, unless you're an ability to have the ability to go buy it cash. And Shoni, I think you're right. Like if you look historically, even in the event of we saw this with concrete a couple of years ago, where there was a shortage in some of the material needed to make concrete, and the price skyrocketed. But within a short amount of time, this was even before COVID, within a short amount of time, they caught up on production, and the cost to create concrete went down significantly, but they did not pass that savings on to the consumer because there was so much building going on. There was no need to do it. And so from a business perspective, even though they were getting it done cheaper, there was no incentive for them to do it because the demand had already been set at a price, and the demand didn't slow down when the prices were up.
Yeah, I think it's just a sustainable over time, slight increase on the price of goods, right? Because even when we went through COVID, I know we target the federal government quite a bit, but there's still a lot of things they did post-COVID that did keep us out of a depression, So I think some of their stimulus and whatnot, but they threw a couple $1 trillion into our economy to prevent a depression. So that did rise a lot of the asset classes up. People felt like they had a little bit more discretionary spending. They were getting, little checks that the government was wanting you to go spend at the shopping malls and restaurants and stuff to keep some of them afloat. But we also ran into the COVID supply chain issues, which just wreaked havoc on our inventory. And then people had a little bit more money. So prices just went up in so many categories so quickly. So I think them actually returning back to an over time sustainable growth, like we always say, real estate on average goes up 4%, but we have some crazy upswings and some downswings here and there. Yeah. So I think if we were to just stretch out the map of inflation on a lot of these product types, if we do get down, yes, technically that's deflation, but over time, it's still a sustainable growth in the price that feels, conservative or fair.
Yeah. I think you bring up a good point. Like one of the questions I had posed to you guys is what lessons can we learn from history in regard to inflation? And normally inflation is caused by one of three. If you go back to your economics classes or economics classes, they call it either the demand pull effect, which is infusing more capital in a market, right? Which if there's more money available, people spend it faster, which creates a run up on prices. There's what's called a cost push effect, which is when the price of commodities go up. And if the price of commodities go up, there's a trickle down effect. For example, like if the price of oil goes up, then it costs more money for a construction company to dig a hole because they're burning more fuel. So they start charging more. And then the last one is built-in inflation, which is the employees or the workforce demanding more money because they could go get a job somewhere else for more money. And to your point, Johnny, I think historically you could almost pinpoint one of the three that's causing the problems. We kind of had the perfect storm where kind of all three of those effects were showing up at the same time. The question is which ones are reversible? Like, for example, with the war with Russia and Ukraine, put a lot of pressure on commodities from a grain and an oil standpoint. Could we catch up on that over time? Perhaps. But to your point, Shoni, like some of the cost of things have gone up that we probably aren't going to recapture and say, oh yeah, that Happy Meal now should be $2.20 again, not $7 or whatever it is. I don't know how much Happy Meal goes for now, but you're getting the point I'm making there. So what, from your guys' perspective, before we jump into actual assets that we're going to think through to hedge against inflation, what lessons can we learn from history, how inflation has showed up?
Well, I also interpret this question like, what can we learn from history in our investment strategy as well? I think, like I got in the business, kind of there was a little bit of a peak, but I really only knew the Great Recession. I saw the upswing. I've now seen this cycle. So like most of the very wise, smart, intelligent investors that have seen a lot of cycles, they pay attention to what happens before and after those cycles, and even in hindsight, COVID, it almost seems so logical that like, hey, we're going to throw a bunch of money. It's like we're throwing rocket fuel on the economy. We're printing a bunch of money. Like, of course, that's going to make stuff go up. I even remember I'm like, hey, when all of a sudden travel stopped, Delta Airlines, Royal Caribbean, like all those companies were just tanking. And I'm like, hey, I should buy some of that stock when it's at all-time lows. Like, do you think we're never going to return to air travel and cruise travel? Like, of course we are. So I threw a little bit of money in those stocks and it went up a little bit and then I sold it. But if I was smart, I would just watch these trends, be patient. Anytime there's bad that happens, good that happens, there's always like an investment correlating decision that can be there. So I think you just have to step back and just totally look at the macroeconomics of what happens in the world and the economy as we go through these major events. And inflation's inevitable, pandemics are inevitable, wars are inevitable. But what I've also realized too is just sometimes, it's never as bad as it seems and it's never as good as it seems. So if you kind of just like have a little bit of that perspective, just what happens over long term, and then construct an investing investment plan based on that, I think it can pay for it.
Yeah, I think
Shoni?
what Johnny said is honestly so important to just understand that really when we talk about inflation, we know it's here to stay. Like inflation is a healthy inflation, roughly 1% to 2%, is built into every country. Really, every country has their own inflationary kind of levers that they pull. But one of the questions we have to ask ourselves is are we preparing our own personal finance in our own investments to make sure that we're on the positive side of the inflation impact? Meaning people that have assets tend to actually have they benefit from inflation in a lot of extents, right? And we most of my portfolio is real estate, and in this inflationary time, it's actually done great because it's increased in value, right? And so we have to really just have this mindset of, are we being a consumer or are we being an investor? Because what happens is when you're on the investment side, you actually tend to benefit from whatever inflationary metrics end up happening. Your assets tend to grow in value. And on the flip side as well, if you don't have assets, it actually can be damaging and deteriorating to your wealth building journey. And so just making sure that we're consistently every year reallocating our assets and making sure that we have, we're making investment decisions that do benefit us regardless of where inflation's at.
Well, and that's where I think it was 7-8 years ago was when I first heard of what the K economy is. Like the economy is just people that own stuff. Like you're going to roll with the economy up. Like the people that don't own anything, have no assets or whatever, they've never got into like the ownership phase. They're just going to keep going down, and that inflation is going to be counterproductive to them. And again, it's just hard. Like the first rental property I bought, like the first real estate property I bought, I was terrified. I freaked out. I had no idea how I was going to pay for it. The prices seemed expensive. The payment seemed expensive. I had very little confidence in my future that I was going to be able to pay for it. But again, I got it. And then somehow I was able to build on that. And then I was able to build on that, So I think part of that is you just want to be on the right side of the K. And I think the people that were on the right side of the K are trying to help pull as many people up and get them to go have that courage to change their life and legacy. But it's crazy. It's difficult. Everything, even when I bought rental properties 10 years ago, it felt very expensive. 5 years ago, very expensive. Right now, it feels very, expensive to buy something. So I don't think that's totally ever going to change.
Yeah, I agree with that. And you can't let that be the determiner. Like, for example, I was telling somebody yesterday, as we were talking about one of my rental properties that has done phenomenally well for me. I bought it for $62,000 in 2010. And that same property now is probably worth, $4 something, $450 or $425 or whatever. But would I buy that same property today at 375 or 385 at a discount from its current market value, if I knew that I bought it at $62,000 and was so stuck on that, I wouldn't buy it. But if I'm looking at this economy moving forward, I'd be like, yeah, I will buy that. I will buy that property, right? So I think it's a great transition point right now. Shoni, I think you bring up a great point that I tell people all the time, like, hey, yes, it's important to understand the world economy. It's important to understand the US economy. It then becomes important to understand the economies the sectors of the economy in which you want to invest. But the economy that most people never take the time to talk about is each one of us have a personal economy as well. And Johnny, to your point, I think that was a big aha for me too when I first was presented with the idea of this idea of the K economy, of why are some people able to succeed and win through a market while other people are struggling. Like even right now, I think a lot of people, you go to them and say, are we in a strong economy or a weak economy? I think you'll get a 50-50 answer from people saying, no, the economy is actually doing better than we anticipated, versus a lot of people think we're in a recession, which there's no data showing that we're actually in a recession, right? Yeah. So I think it becomes important for us to say, to your point, Shoni, like, okay, if we believe that to be true, and we believe there's going to be some patterns showing up, it will show up a little bit different, but if we believe inherently in the rules and fundamentals of economics, we can make some decisions on how do we best set our dollars up to create the wealth that our families deserve moving forward, right? Any last comments on the overall thought around inflation before we jump in and start talking about some of these specific vehicles and kind of getting some thoughts on them?
Yeah, the way you live your life, the timing of it, sometimes internal, sometimes external circumstance, like it changes what your personal economy is, regardless what the news says. I met a guy that sold a company in 2007 for several $1 million, and it was perfect timing in hindsight. He didn't really plan that. But when the market crashed, Great Recession, everybody was just panic stricken. Everybody was like unloading things, short sales, foreclosures were happening. Where for him, he's like, zero negativity. It was only a buying opportunity for him. Because he's like, wow, these lots are like pennies on the dollar. I'm going to buy as many as I can get. He has just a spreadsheet of pages of things that he bought in the Great Recession that probably 10x his net worth in like 3-4 years. So again, like, especially now, like when the economy kind of went down, business profits start to evaporate, incomes are like holding because inflation's just, tearing apart any bonuses or raises you were getting. If you were rolling into this last shift at $30,000 living expense versus $3,000 living expense because you were, living below your means, like you're going to have a dramatic different effect on the way out. So I think the way that you play your personal financial life totally can insulate you from what happens as an economy out there. So I think you've got to have a good investment plan that also has that conservative piece to it that helps you blow through and financially survive your mistakes at the end of the day.
Yeah. I think that in, kind of as a transition or a bridge to this next portion is that, wealth building, investing is really like a sport. Every sport has a language, it has rules, and it has a way to keep score. And so internally, we have to ask ourselves, am I studying the rules? Do I know the rules? Do I understand the language? And do I have a way of keeping score? And, when we went down to Argentina and Chile earlier this year, I was one of the individuals that I don't speak Spanish. And so I realized very quickly that I was at a disadvantage compared to everybody else that was able to speak Spanish. And so, if I relate this to wealth building, investing, and just understanding my personal economic standing, I realize I have to study the language, I have to know the rules, and I have to have a way of keeping score. And for me, I'm studying consistently what are the different levers that cause inflation, and then again, how can I hedge my bets and make sure that my portfolio is set up to benefit my family. And so I think that's just one of the simple encouragement is just say that, hey, this is pretty much a sport. We just have to study the language, know the rules, and have a way of keeping score.